Yo, what up, everybody? What up? How y'all doing tonight? How y'all doing? I hope everybody's well. You know what I mean? I hope the weekend's going well. I'm sorry, not the weekend. We in the middle of the week, right? So, I hope the week is going well for y'all and everything like that. I decided to go live tonight, talk to y'all about a couple of things, just talk a little briefly, about a couple of things. So I'm going to go ahead and get started now. I'll be saving this video as always, so, people can always watch it later. But, so here we go. This is a hashtag Get Real Woke discussion on corporations. So, I don't want to, this is just a brief discussion. I just want to put out a couple of tips, a little bit of advice, help people out. So, when business owners first start their businesses, especially new business owners, a lot of people tell them that, oh, you can write off losses, you can carry losses for 2 years, you can, all of these things, right? And it is true that you can write off losses, and generally you can carry losses for 2 years. That's true, right? But here's the thing. So think about it like this. When you have an LLC, at the end of the day, or when you have any type of corporate structure, be it an LLC, C corporation, and anything of that nature. So from a lending standpoint, the general rule of thumb is to qualify for a bank loan, you had to have been in business for at least 2 years. Now, here's the other thing. In order to qualify for that bank loan as a business, your business has to actually have operating revenue and profit. So if you've been in business for 2 years and you've showed losses for 2 years, well, that doesn't meet the operating net profit or operating profit margin and net profit margin requirements to be able to qualify for a loan. And so the reality of the situation is you're not going to be able to qualify for a loan, period. Right? So that means that the 2 years of history that your LLC has, your corporation has, really doesn't do you any good, because you still can't qualify for a loan anyway, because someone told you that, oh, if you write off losses for the first 2 years, you can file that on your taxes and then you won't have to pay taxes. Yeah, that's true. That's true. You won't have to pay no taxes, but you won't have any revenue either. And so that's not going to work out for you. You won't qualify for loans. Your business won't be able to grow and scale the way it can. Now, here's the interesting thing. There is a way to lower your tax liability and still show profit. It's called depreciation. So what is depreciation? So depreciation is when your business owns an asset, a tangible asset, let's say a car, a building, a piece of equipment, etc., and you buy that equipment new. Well, after a year, of course, because you've used the equipment and because it's no longer new equipment, it's used equipment. You've used it. And so obviously, because of your use, the value of that equipment is not the same as it was when you bought it. So let's say, just nice, easy numbers, you buy a piece of equipment. Let's say it cost you $1,000, right? You use this equipment for the whole year. And then at the end of the year, when you go to value that piece of equipment again, you find out that that equipment is now only worth $800. At that point in time, there is a $200 loss in value from the time you bought it. That is called depreciation. And you can count that depreciation in your assets. So let's say that, or in your liabilities, in your expense. It's called a depreciable expense. So let's say now you've lost the value of $200 on this piece of $1,000 equipment that's now only worth $800. So now what you can do is, let's say you had a profit of, let's say you had a net profit of, let's say, well, nice easy numbers, let's say $1,000. Well, you still show a net profit of $1,000, but from a tax standpoint, now you only have to pay taxes on $800. Why? Because you have a $200 depreciation expense. Because a piece of equipment that you bought and own, right, has lost value over that year. Now, of course, the IRS has guidelines, based on how depreciation works for different pieces of equipment and everything like that. But let's take a car, for example. Everybody has a car. Everybody needs a car. Most people need cars to get back. And I won't say everybody has a car. Let's not say everybody has a car, because some people take bus, ride subway, all of that. But if you live in a state where, getting around requires you to have a car and you have a business, chances are you likely have a car, right? Okay. Most people will go out, they'll have an LLC, they'll set up a business, it's great. And then they'll decide they want a new car. And what they'll do is they'll go get that car as a lease or with a financing contract in their own name. Right? Brand new car. You got it in your own name. But you have an LLC. This is a mistake. And I'll tell you why. See, when your LLC owns this car, let's say, nice easy numbers, you buy a $10,000 car, brand new, right? Brand new. Never been driven before. Fresh off the lot, newest model, all of that, you spend $10,000. Boom. The moment you drive that car off the lot, its value depreciates 25%. So that means immediately driving it off the lot, it loses $2,500 worth of its value. Now, if you owned that car underneath an LLC, that $2,500 in lost value could have been a depreciation that you could have used to lower the amount of profits that you have to pay taxes on, and therefore lowers your effective tax rate. So while you may have a profit of, let's say, nice easy numbers again, $10,000, because you have now a $2,500 depreciation, you only have to pay taxes on the remainder, which is $7,500. So you still have a profit of $10,000, but you only pay taxes on $7,500. That's the power of depreciation. It allows you to still show profits, but it still allows you to also lower your effective tax rate. That's the cool thing about depreciation. Now, so here's another thing. So I just wanted to talk about depreciation a little bit. Again, this is a brief discussion. I'm just giving a brief overview here just to, give you something to think about. Now, let's say you start an LLC, right? Or you start any type of corporate structure, a C corporation, LLC, LLP, however. You start a business. You incorporate this business. Now, this business has its own tax ID number. What you have to understand is you have to treat your business like a separate individual, like a separate person. Treat it like it's another person, completely separate from you. Your business gives you a limit of liability. So that means that generally the owner of the business is not responsible for the business's issues, lawsuits, etc., etc. So if you get into a lawsuit, generally, the lawsuit will sue the business. Now, let's say you own this LLC, and let's say that you have a cell phone in your name, you have your rent in your name, you have a car in your name, and your business is making good money. And you decide that you're going to take your business debit card and you're going to use it to pay your personal car note, your personal phone bill, your personal rent. What happens at this point? At that point, you are doing what's called commingling your business funds with your personal funds. And you are commingling business expenses with personal expenses. And the moment that you begin to do that, you do what's called piercing your corporate veil. And what does that mean? Now, where that business was completely separate from you, you have now effectively made you and the business one. So now if the business gets sued, not only can the person sue the business, but they can come after you personally because under the law, you are now treated as one entity. You are together simply because you used your business debit card to pay your personal expenses. So now the question becomes, hey, but my business is making all this money. How is it that I can get this money out of my business that my business is making without piercing my corporate veil? Well, there are two ways you can do that. Number one, you can make yourself a W-2 employee of the business. And as a W-2 employee of the business, right, now you draw a salary from the business. And that salary is your personal money. That salary is also a write-off for the business. So now, right, what you're doing is you're drawing a salary, and you can use that salary, right, to pay for your personal expenses. Another way to do it is to make yourself a 1099 independent contractor. You're a consultant of the business. And now you can pay yourself a consulting fee from the business, and you can use that money to pay your personal expenses. Another option that you have, now let's say that, you have this cell phone bill, you have all of these things, right? Now, you are the owner of the business. You're the CEO. You're a senior executive. So if you're a W-2 employee, you could set it up in such a way as part of what's called your remuneration package. This means all the fringe benefits that you get on top of your paycheck, right? The company could literally go out and start a cell phone plan in the company's name. And the company could issue you a corporate cell phone that the company is paying for. And you get a corporate cell phone because as a part of your employment agreement with the company, right? The company provides you a corporate cell phone. The company could go out and lease a vehicle, right? Now check this out. And as a part of your employment with the company, one of your benefits is that the company provides you a company vehicle, a corporate vehicle. So now you can drive this vehicle, you still have your phone. Heck, the corporation can actually lease an apartment. Yes, you'll be a personal guarantor on that lease, but that lease comes out in the name of the company. Now when that happens, right, as part of your employment agreement, the company furnishes you with corporate housing. You're accomplishing the same thing, but you're doing it in a way that doesn't pierce your corporate veil and make you and the company one. See, in business and in legal things and business, right? It's not what you do, it's how you do it. It's not what you say, it's how you say it, right? The method in which you go about accomplishing what you're trying to accomplish can be the difference between success and failure in business. And so understanding these little nuances is very, 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 very important. So I wanted to share these things with you, and I see that we have some questions here, so I'm going to take some questions. So DJ L. Murray asked a question. He says, so it's not legal to use business funds for personal funds. Okay, well, so it's not a matter of whether it's legal or not, because it's not necessarily illegal for you to use your business funds for your personal expenses. There's no specific law that says you can't do that, but there are laws that and rules that govern what happens when you do that, which is you pierce your corporate veil, you give up your limit of liability, right? So it's not a crime. It just destroys the protection that the corporation or the LLC was specifically set up to provide, which was to give you a layer of protection in the event of a lawsuit, right? Someone couldn't come after you personally for everything you own. They could go after the business, but they couldn't go after you. But once you pierce your corporate veil, now they can not only sue the business, but they can go through the business and come after you and everything you have personally. That's a dangerous thing. So I just want to share these little things with y'all, just a quick little discussion here. If you have any questions, comments, concerns, anything like that, feel free to reach out to me on my DM as always. But, if you have a specific thing, that you want to discuss, regarding your own business or anything like that, feel free to hit the book now button, book a 30-minute assessment with me. I'd be more than happy to talk to you, discuss it with you, see where you're at and how I might be able to help you. All right. As always, feel free to like, subscribe, follow, share this information with anybody that you think can benefit. The more people hear this information, the more people can benefit. I appreciate y'all as always. Feel free to check out, some of the books I've written, investing for success, investing tips for the everyday person. I recommend that anybody that's looking, to begin that journey to investing properly should probably read that book. I think that's a good idea. And the link is in my bio. Feel free to click the link. It's going to take you right there. I recommend that you check that out. As always, feel free to visit fredrickdscott.com. That's my personal website. Again, link in the bio. I got a YouTube channel. Feel free to check out the YouTube, subscribe to that. Also, I have some hashtag for the free resources on my website. So, I taught a 4-part series on credit repair. If you want the letters that'll help you be able to, fix your credit on your own without having to pay somebody a whole bunch of money. Listen, I taught a 4-part series on that. It's on my YouTube. It's on this Instagram page right here. And the letters are available. Hashtag for the free, baby, for the free. Listen, I also put a budgeting spreadsheet together. That's in my hashtag for the free resources as well. I did a whole course on budgeting and saving. So if you want to learn how to budget, learn how to save, learn about the things you need to know to be able to do that successfully, and have a workbook that you can use, an Excel spreadsheet that you can use to be able to input those numbers and begin to budget and save for yourself. That's hashtag for the free. I built that workbook myself. You know what I mean? It's definitely official tissue, and it's free for y'all. Okay, listen, I do this for y'all. Like I'm really trying to benefit the community and make an impact and help everybody out as much as I can. All right. So definitely, as I said before, like, subscribe, share, follow. You know what I mean? And I'll holler at y'all the next time. I'm out.